Been off to an uneven start to 2025 in the stock market, and our next guest says a deeper pullback is likely in store. Let's bring in Bruce Richards, CEO of Marathon Asset Management, with us at Post 9. Welcome back.
Hey, Scott.
I mean, you're looking for maybe a 10% decline from here, correct? Which is going to be painful.
Well, you know, the Mag 7 is already down 10 from peak to trough, but S&P's not. And so you look at the S&P, it's down 1.5% year to date, intraday, and up as much as 3.5% intraday. And I was on your show last time. I said equities this year would be down as much as 7 and up as much as 20. So we haven't seen anything yet. Vol's on the table. Yes.
Well, you sat down and you said the cheapest thing in the market right now is vol.
From an equity perspective, absolutely.
Yeah.
And so we pierced 20 yesterday. I think we go higher from here. The one thing we're not seeing in terms of vol spiking up is credit spread vol. Credit markets are incredibly stable. So this is all about equities being somewhat fully valued and some of the economic policies that are coming out of Washington that might lead to a more stressful growth. And so we're going to have to deal with that in the first half of the year until we can get to the latter part of the year when the Fed's going to start easing, and that's when equity markets rock.
What do you make of what Howard Marks said earlier? I played the sound, right? The stock market expensive but not crazy. Paul Singer has a very interesting quote in an interview that he gave, I think, over in Europe, where he said, and I want your reaction to this, he said, quote, "The state of stock markets today are just about as risky as I've ever seen. Leverage is building and building, risk-taking is building, and those statements apply also to governments. It's absolutely astonishing, this negative interest rate policy in Europe and Japan and Switzerland, and zero interest rate policy for, 10 years in the U.S.? It's crazy." What do you think?
And so I think there's some historical perspective to that, because ZIRP is crazy. And the rates that he's talking about negative, they're no longer negative, and we no longer have a ZIRP policy. So we've seen the backside of that. But too much deficit spending that we've seen here in the United States leading to these huge deficits on such a vibrant economy is the pain point we're in now, because what the administration is trying to do, and we'll see how they do with it, but what they're trying to do is cut about $1 trillion out of spending. And there's some pain in that, because the recipients of those $1 trillion represents, we think, up to 1 million jobs in the marketplace. And so when you cut all that spending, the private sector that's the beneficiary of that, plus cutting 10% of the workforce in the federal government, which is out of 2.4 million jobs, 240,000 jobs, together it's 1 million jobs. And that takes you from 4.1% unemployment, we believe, to 4.5% unemployment. And so the pain of getting through that
how do you get through that, right? That is going to be painful. And it's going to be a potential hit on growth. How can it not be?
It will be a hit on growth, and we think growth won't be 2.3%, which is what Fed GDP says now at the Atlanta Fed for the Federal Reserve. We think it'll come in this year closer to 1 to 1.5. So it'll be a hit in growth, but the back end of this year, you'll get through that, because you'll be through that pain, we believe, and the Fed will be easing, and that's when the stock market starts to rock or trade higher. So we think the first half is going to be difficult.
Okay.
Expect a lot of volatility, but the most amazing thing is no recession, and the reason why I'm calling for no recession, despite rates being down 40 basis points for treasuries, and it's kind of telling you a little bit, be aware of it, is because the credit markets are so stable. Look at the credit markets. For now. And I think that they're rock solid, the credit markets, because we don't see credit risk increasing. Actually, we see some credit risk coming out of the markets.
But you're a believer, and you posted this, I saw on LinkedIn, 1 step back, 2 steps forward.
Right.
So that's how you are processing what's happening in Washington, also describing a President Trump 2.0 that you think is less focused on the stock market now, unlike in the first term where the stock market was kind of everything.
Yeah. Trump 1.0, all about stocks, because you had a zero rate policy or very low rates. Today you have higher rates, big deficits. He wants to bring rates down, does 2 things. Number one, it helps the government fund more effectively and create more of a balanced budget, number one. And number 2, it brings mortgage rates down, which is hugely stimulative for the economy.
Which are barely coming down. I mean, they just came in, but the housing market's been a mess.
But you have to bring rates down and bring it down even further. And I think all these actions that are happening will help rates come down.
So you're a believer in what they're doing?
I think it's too early to tell, but everything I'm saying is 1 step back for the first half of this year as you get through this, to take 2 steps forward, because you'll be at a balanced budget, pro-growth on the backside of this, And it takes a little pain because there's so much excesses in terms of the government spending, the big budget deficits, that we have to kind of downsize. And downsizing big government to put capital allocation into the private sector is hugely beneficial.
Lastly, before I let you go, the best opportunity in your wheelhouse of credit today is what?
So what you're seeing right now is remarkable. Absolutely remarkable. Remember all that creditor and creditor violence that we've been talking about, where companies take assets, move it over to an unrestricted sub, and creditors fight against creditors and benefits to equity? Look at what just happened at Altice in France with Draghi. He took $25 billion of debt, turned it into $20 billion of debt. All the creditors, first lien, including the CLOs, and second lien came together. Big shout out for Gibson Dunn, who put this all together, who's doing these cooperative agreements. You've seen it in Bausch now, which is a Carl Icahn, it's a public company, but Carl Icahn's the biggest shareholder. He wants to take the eye care part of it, spin it off at the expense of the creditors. The creditors are coming together and saying no more creditor violence. And so we're seeing a lot of opportunity buying this discounted debt to work with the other creditors to come up with a really good outcome for both the company and their long-term viability and the creditors as a whole. And so direct lending, asset-based lending, and these opportunistic strategies, tremendous alternative asset opportunities, and that's why Blackstone, Apollo, and the alt managers are up today.
Sure,
and a lot of managers.
But obviously, the return on the lending, because rates are coming down, and you think they're going to come down further, the return isn't as great as it once was in direct lending for starters.
Not the peak, but we're using internal leverage. Our financing costs are coming down, and the spreads are actually holding well, because what we're not seeing is spread volatility in high-yield loans or really the alternative private credit sector. So we're seeing spreads very stable. It's a great time to lend.
Okay.
And so it's working very well for us.
We'll talk to you again soon. Bruce, thanks.
Thank you, Scott.
That's Bruce Richards of Marathon.